Hello and welcome to Earnings Echo. We put together the most important information about Apple Inc. Today we are digging through a massive stack of Q2 fiscal year 2026 earnings reports, analyst notes, and the management call transcripts. Our mission for this deep dive is to figure out if Apple's huge quarter is the start of a structural acceleration or, just a temporary spike masking some serious fundamental cracks. Let's just get straight into the hard facts. How did the quarter actually shake out?
The raw numbers are, well, they are massive. Revenue hit $111.2 billion. That is a 17% jump year over year.
Right.
And profit per share, or EPS, came in at $2.01, which is up 22%. Plus, gross margin hit 49.3%. So across the board, every single one of those figures comfortably beat analyst consensus.
Okay. And looking forward, they guided for 14 to 17% revenue growth for Q3. They also threw in a $100 billion share buyback authorization and a 4% dividend raise. But I have to ask, what is actually driving this? Are they just getting a temporary bump from the iPhone 17 launch, or is there recurring cash flow here?
It is definitely sticky, and the data proves it. iPhone revenue hit $57 billion, growing 22%. But the real anchor here is services.
Because of the margins.
Exactly. Services reached an all-time high of $31 billion, with a massive 76.7% gross margin. We also saw Mac revenue grow 6%, heavily driven by the new MacBook Neo.
Okay, but if we look at the guidance, Q3 gross margin is projected to drop noticeably down to 47.5 to 48.5%. If revenue is growing so well, why are their profit margins shrinking?
It really comes down to supply chain bottlenecks and hardware costs. They're facing significantly higher memory costs right now.
Just across the board.
Yeah, and on top of that, they are struggling to get enough of the advanced node SoCs. Those are the highly complex microscopic chips that act as the brains for the Mac Mini and Studio. So producing those specific machines is suddenly getting a lot more expensive.
That makes sense. But on the earnings call, management seemed incredibly optimistic despite those supply issues. They heavily pushed the adoption of Apple Intelligence in the enterprise space. Plus, we got a major leadership bombshell.
Right. Tim Cook is officially transitioning to executive chairman.
Yeah, and John Ternus takes over as CEO on September 1st.
Right. And while the tone regarding AI was highly optimistic, management also issued some very clear warnings regarding macroeconomic risks. Cook explicitly stated that those rising memory costs aren't just a short-term issue. They're expected to worsen significantly as we move beyond the June quarter.
So, if profit margins are shrinking because parts cost more, how is the stock price still climbing? Let's figure out what investors are actually expecting by looking at the valuation. We ran a reverse DCF based on the analyst notes. And for you listening, a reverse discounted cash flow isn't an exact science, but it basically tells us what kind of future growth the market has already priced into the current stock.
Exactly. And right now, Apple sits at a $4.05 trillion market cap. To justify that price tag, the market implies a 14.9% average annual growth rate in net income over the next 10 years.
Hold on, that sounds incredibly high. What does that mean in actual dollars?
It requires Apple's net income to essentially quadruple from where it is today, up to roughly $419 billion.
How does that compare to what they have actually achieved over the last few years? Have they been growing anywhere near that fast?
Not recently, no. Their historical 5-year average annual growth is only 10.3%. And if you look specifically at the stretch between fiscal year 22 and 25, net income growth was actually negative 2.1%.
Wow. That makes that implied future growth look, well, highly dangerous. Especially when you consider that we've basically hit iPhone market saturation.
Right.
Plus, the EU and the DOJ are forcing Apple to open up the App Store since they take a roughly 30% cut there. Losing that walled garden directly attacks their most profitable revenue stream. Given all that, this current valuation leaves almost zero margin of safety.
It is a stark contrast. The data clearly shows they are fundamentally accelerating right now, largely due to this iPhone 17 cycle and those record-high services numbers. But the price tag demands absolute perfection.
Which brings us to the ultimate echo for you today. Apple's engine is definitely accelerating again. But to justify this sky-high valuation, they have to deliver relentless, flawless growth in services and perfectly navigate the upcoming memory cost spikes.
Exactly. The company is operating at peak performance, but the stock is priced as if that peak is just the baseline for the next decade.
So here is a thought for you to mull over. If Apple needs flawless financial growth just to maintain this stock price, Will John Turnus be allowed to take the massive creative risks Apple is historically known for when he steps in as CEO this September?
Or will he be forced to play it entirely safe just to keep the financial math intact?
And finally, the obligatory disclaimer. All content in Earnings Echo is AI-generated information and does not constitute investment advice. Investing involves risks. We assume no liability for your investment decisions. Do your own research before taking action. Numbers checked, portfolio prepped. Catch you again soon.